What's happening is the California Department of Insurance received a request from the California Fair Plan Association. Remember, although they both start with California, the Fair Plan is not a government agency. It's completely privately run by the admitted insurance companies in California. And the Fair Plan went to the Department of Insurance and said, okay, we need another $1 billion in order to access our reinsurance reserves. And what that means is the Fair Plan has money on hand, and then it has access to reinsurance, which is basically other insurance companies that it's been working with that has the ability to pay their claims as well. They share the premium with the reinsurance companies, and the reinsurance companies help pay the claims. But in order to get access to that money they have, you could look at it like a deductible. And that's a measly $900 million.
Uh-huh.
So the Fair Plan needs that money to be able to have access to that extra money that's there. So based on regulations, the Fair Plan sent the request to the Department of Insurance. The Department of Insurance said, okay, go get the money from the private companies. It's okay with us. The individual insurance companies are now getting an assessment based on their market share, right? So, for example, State Farm is getting assessed about 20% of that $1 billion, and every other carrier down the line. What happens then is the Fair Plan will have sufficient funds to be able to access the reinsurance, and based on the amount of reinsurance they have, I believe it's about just under $6 billion. That should be sufficient to pay for all of the outstanding and expected claims that Fair Plan has from these fires. So that's the first part.
Okay.
Now, how does this trickle down to you and me?
Yeah.
What happens is, based on current regulations, the first $1 billion, it sounds funny to keep talking about billion, like, just $1 billion.
Sure.
The first $1 billion that gets assessed from the Fair Plan, the private insurance companies, half of it, they just have to eat it. It's just cost of doing business, guys. Just cough up the money. The other half, so in this case, $500 million, they're allowed to appeal to the Department of Insurance to pass that on to policyholders. What that means is they're allowed to go to the Department of Insurance and say, hey there, we've got this $500 million. We would like to get a little bit of this back from our policyholders. They will go back and forth with the Department of Insurance. And as you know, the department is extremely consumer friendly. So however this will go down, I'm sure it's going to be as softly done as possible for the consumers versus the carriers. And what will happen is the department likely will approve some form of an assessment to policyholders based on a percentage of their premium. So someone that's paying a higher premium would potentially have a higher assessment. Someone that's paying a lower premium might have a lower assessment. And it's usually spread out between 1 and 2 years. So if we just do some quick and dirty math for fun, $500 million, and you divide that by all of the policyholders in California, it comes to roughly about $60 per policy, which is divided over 2 years. It's kind of like Starbucks money, I guess.
Yeah.
But, not to minimize it, because it's not fair necessarily when you stop and you think, but I didn't have the loss. I didn't do this. Why am I having to pay this? But if we're looking at the just dollars and cents, on average, it might be somewhere around that amount spread over a 2-year period. The other consumer protection element of this is the insurance carriers are not permitted to take that expense and turn around and go back to the Department of Insurance and say, hey, look, we had this $500 million we had to spend, so please let us increase our rates because that's now part of our expenses, right? Now that's money that we've had to cough up. They're not allowed to go back and let that impact future rates that are approved from the Department of Insurance. So the idea is that the assessment comes in. Fortunately, it's enough to get the Fair Plan to pay all of its obligations with its reinsurance. Half of that burden is paid for by the private companies. The other half is paid for on a percentage basis over, it's going to be 1 or 2 years, I would suspect, from policyholders in California.
Okay. And every policyholder in California?
Every policyholder from an admitted insurance company in the state of California.
Interesting. Okay. but maybe about $30 a year, you said. Good.
Again, they really don't like to talk about dollar amounts because it's a percentage,
Yeah.
right?
Right. I get it.
Obviously, someone that's paying $20,000 in premium is probably going to be paying a larger surcharge than someone that's paying $2,000, right?
Of course, yes.
But if you, like I said, you just do the quick and dirty math, that's roughly what it comes out to be looking like. The way I'm trying to explain it in general is if you're in a situation where regulation prevents you from collecting sufficient premium to pay your claims, and that's the situation that's in California for basically for a long time. It only works until there's a large enough event where you got to pay claims. And then at some point you have to play catch up, for the premium that you were not able to collect all those years. We're in that stage right now where we're playing catch up for the premium that wasn't being charged accurately over the last X number of years.
I see. Okay. Well, our insurance expert there, Carl Sussman, always appreciate the breakdown on this stuff. Thank you.
Sure thing.